ladies and gentlemen, in our ongoing series of Market Masters, we get to meet you, the finest brains on the Lal Street, professionals who have navigated the bull and bear markets with equal ease, who over the last many decades have made supernormal money for their clients. In that respect, we are now joined by Mr. Jyotivardhan Jaipuria, founder and MD of Valentis Advisors. Namaste, Jyoti ji, and a very warm welcome to you. So the smiles are back on the Lal Street. Nifty is at a record 7 month high, and even our foreign friends are now buying in a frenzied manner. In, please explain to our viewers the sentiment on the Lal Street at the moment. What is looking good, and where do you see momentum building?
Yeah, so see, obviously the markets have recovered, especially the large caps have recovered. They're close to the highs from the low. We've probably seen like a 13-14% sort of increase, which has come in. Uh, so there were a lot of negative news. There were lots of worries, which somewhere eased. The last one was, of course, the India-Pakistan, conflict, which, after the ceasefire, things have looked good. And so market gave a big bounce for that. But otherwise, if we see before that, the tariffs were a big concern for the market. And the way it's been going over the last few weeks, it seems that the tariffs are going to be eased off rather than at, remain at a very high level. Because even for China now, there's a 90-day pause which has come in and tariffs have been brought down quite significantly. So at least the way everybody looking at it now, tariffs are no longer a big overhang on the market. It may be not as good as it was before it started in April, but the worst of the tariff fears are not there. So to that extent, I would say it's more like, some of the negative news which are there are not playing out as badly as we thought it would be. Same way, if you look at India, earnings have been on the margin. They've
Yes.
beaten expectation were very low to start with. But so
Correct.
far, the way it's looking, they're going to beat expectations, and
Hello,
which is always good because after 2-3 quarters where their
hello, Anji.
earnings were
Oh, Khan,
missing
right?
expectations, this is good to have expectation getting beaten. And you've seen rate cuts, you've seen easy liquidity, so that way things have looked good for the market.
Right. And to that, add crude oil prices at a 4 year low, inflation at the CPI level at a 5 year low. Lots of positives, it seems, are now coming together in the market. Uh, Jyotiji, do you see a record high on the Nifty this year? We've already had a fresh peak on the Bank Nifty and the Fin Nifty. What is your assessment of the Nifty for the remainder of the calendar year?
So see, we've looked at it as this year being like a year where it will be a year of consolidation. We've seen really strong returns over the last few years, and somewhere you need to absorb those gains. Markets are not very cheap. They had at some point become reasonably valued when we spoke last, I think, but now they've had a rally again, so it's they're not a very cheap market. So it's a year where you'll probably consolidate, where earnings will come. Hopefully, earnings recovers, the economy recovers, and to that extent, you start getting a return in the market, which is probably lower than the earnings growth, so that at least the valuations start to get more reasonable. So I would think it's a year where we'll have a consolidation, where we'll be range bound, and probably we are looking at uh, the year giving a single digit return in the market.
But your job as a fund manager running a PMS scheme doesn't get any easier. You have to deploy fresh capital. You have to keep existing investors occupied. But for the last maybe 1 month or so, ever since this rally has taken root above maybe 24,800 on the Nifty, or maybe 24,000 on the Nifty, what has your PMS been doing? Are you a net buyer? Have you consolidated your existing stocks, maybe sold off some? What's been the approach at Valentis Advisors?
So yeah, we have been net buyers, and we generally are net buyers because as long as we get inflows, we'll be buying. But also we had some cash, 2 months ago in the portfolio. So some of that cash we've used at lower levels. Especially for us, it's all these conflict time. We generally like to buy. Our CU's philosophy is that we buy when people are scared, and we generally tend to hold off our buying when there's a lot of
Hmm.
euphoria in the market. So for us, all events like a conflict or big tariff change coming which spooks the market, those are the days we like to buy. We get some of these stocks really cheap. So overall, we've been net buyers in the market, and we
Mhm.
continue to be. I would say, our cash levels have come down relative to what they were 6, 7 weeks ago.
And in terms of the fourth quarter earnings, Mr. Jaipuria, what has caught your attention, your fancy, in terms of where profit has grown sharply, even if it is in your existing investments? Maybe a broader sectoral call, has it emerged on the long side?
So, one is of course very broadly, earnings did probably a little better than what the street was expecting. The expectations were very, very low. When we started the season, having a broad expectation was earnings will grow at 3%, or at least that was the broad consensus of the analysts. And from that level, we've seen we probably may end up with more like 7% sort of growth, which gives us a little more confidence of next year, because next year our view is that we'll get a double digit increase in earnings. And so there'll be a recovery in growth, there'll be a recovery in earnings, which will probably help the market. So I think, there's some confidence that, okay, maybe this we are getting to see and this will happen. The other is if we look at like broad sectoral, what we've seen is it's not necessary that this, strong earnings have been followed by strong stock price performance, because very often people are like, okay, where is this going? So for us, we were very happy with the stock price performance of the banks, because that was one contrarian sector which we had been highlighting that things will, uh, you know, pick up in the banking sector. So it's a time to buy because valuations are very cheap. So as you see numbers come out, some of the banks which, did clean up trades where, the now results were not very good. The stock prices actually went up because, people said this is the lows now. So we're going to make, more money by holding this, and probably the next year looking good. The other sector which probably we have been focusing on a lot has been the chemical sector, because that's one area where stocks have done badly for the last 2 years, where the uh, earnings have done badly for the last 2 years. But our sense is when we look at macro data, a lot of the destocking which happened in the chemical sector is behind us now. We probably may start seeing restocking.
Yes.
So we think that the future looks better than what the past has been. And that is being bearing out because some of these numbers have been good, some are not good, but the guidance is looking quite positive as we look ahead. The third one, which probably is in line with the expectation, which is not very good, has been the consumer staple sector, where we've been like quite negative, and even generally the commentary has been a little tepid that things are not really picking up in any meaningful way.
Okay. Mr. Jaipur, I'm sure you watch the daily frenetic activity in the market in terms of what traders are doing, what the brokerage desks are telling you in terms of the pulse of the market. Do you see this revival of momentum in railway stocks, defense stocks in particular, now even PSU banks, as a development that has positivity around it?
Yeah, so I guess the stock prices bear it out, right? What we've seen in most, a lot of these defense stocks is, after the conflict, you've seen a lot of defense stocks go up 50 to 100%.
Hmm.
And, we generally don't buy momentum. So for us, I call ourselves anti-momentum. We buy stocks when they're not in favor. That's the whole free use philosophy. We buy it when it's not in favor. So, for us, our view does not change because the stock prices go up. If anything, we get a little more cautious on some of those stocks that now they've become expensive, and should we reduce our position on them? So these are stocks, I would say defense stocks are stocks which over 3 years, 5 years will do well. But, valuations are not very cheap in them. And the earnings are not going to be one straight line. They're going to be very, very patchy. Ultimately, we have to remember there's one buyer for most of them, or there's huge concentration risk amongst the buyers. So 1 or 2 quarters where they don't buy, or the orders are delayed, or the order implementation is delayed, you could see earnings disappoint, and given high valuations, you could see stock prices come down quite a bit. So these are stocks you want to buy when they're not in favor, rather than jump in them after they've got into favor.
Okay. And how do you see the global situation now? We have a risk on trade emanating because of this US-China pact being in place, do you think it will have a positive medium-term impact on domestic IT? IT is one sector which really hasn't participated at all as far as bulls are concerned. Any views there? Does IT have a representative representation in Valentis PMS?
So, IT is something we've not been very positive on. And two reasons for it. One is if we look at the longer term scenario, what our bigger worry is this whole artificial intelligence AI is going to reduce the demand for the Indian IT basically. The number of programmers required to do the same job is just coming down. And if you read all the commentary of a lot of the global majors, many of them are saying that 30 to 40% of their programming is now done by AI. So to that extent, when you think of a 3 or 5 year view, this trend continues, then you may find that these companies are not growing at all, they are degrowing. Second is near term for us, it's been like the US economy may struggle a bit because of a combination of higher inflation which is coming there, and that probably will start to hurt the domestic demand. If you see the bond yields in the US, they have been rising, and this is even before the latest downgrade got announced, which I guess we'll see the impact today in the markets in the US. But in general, you're seeing bond yields going up, so the bond market is signaling that inflation is coming back and it's not coming down. So to that extent, for us, it's been the environment for global IT is not even the short-term environment is not looking very robust. There are risks to it. So it's a company which, like, these are decent companies, but at these sort of valuations, for us, it's been there better opportunities in the market than really overweighting the IT stocks.
Okay, fair point. So the jury remains out on the IT space, and defense, you feel, seems to have run up a bit too sharply given the recent events that have happened. In terms of secular rallies, Mr. Jaipuria, your ranking of sectors, maybe 1, 2, 3?
So see, what we like today. So one is the banks of the financial space, and that's more because of just valuation. So when we look at like a 10-year valuation, and we do this very, very often, a 10-year average valuation, where are we today? The banks are one space where they still look very reasonably valued versus the 10-year. So that is one sector which we continue to like. The other sector which we are looking at very closely, the cement sector. So that's not done well over the last 2 years in terms of share price performance. It's not had a great earnings growth. But what we are seeing there is one is there's a lot of consolidation in the sector. So because of that, the bigger players have become bigger. And typically when that happens, pricing power comes back. So when this consolidation phase was going on, a new player entered, you saw disruption in the pricing environment that is improving. So that is again something which we think over the next 2 years, the pricing environment will look good. And so it's something which we are looking at. Another sector, like I mentioned, was the chemical sector, which we are looking at closely. Pharmaceutical is something which we like as a long-term secular play. The only thing holding us back over there, it's not holding us back. We have a fair position, but very short term, the Trump whole pharma tariff and what is he going to do about it? It's total uncertainty. No one really knows where it is going. We think that the impact will not be great because ultimately US generics need the Indian companies there, but it's still something that this factor there, but as a sector you want to buy on every dip.
Okay, so it's banks, cement, to some extent pharma, and of course chemicals that find fancy as far as Valentis portfolio is concerned. Mr. Jaipuria, when you look at the broader market now, do you feel coming to the office a stressful job given the pain that we had seen in September till about March, or is it a time to rework the Excel sheets, look at potential mid caps and small caps which can be a part of Valentis? What is your own pulse telling you?
Yeah, so see, for us, it's like, this is the year for building a portfolio for consolidation. It's not a year you'll make more money. The way I
Okay.
characterize this is, we are now playing a test match. and we were playing a T20 all this while. We're now playing a test match. So you have
Okay.
to, defend and build a portfolio. You don't have to go and hit a
Mm.
six every ball. The time will come again to play a T20.
Okay.
So here we are looking
Okay.
at getting stuff cheaper, building a
Okay.
portfolio so that it can give us multi-bagger returns over the next few years. And that's what we spend all our time on. We are basically very, very fundamental focused. And we have very, very low churn portfolio looking at 3 years, 5 years, can we make money in this stock? So for us, the excitement is always trying to find the next multi-bagger.
Okay. Have you succeeded in finding the next multi-bagger?
Time will tell, but hopefully we have got a few stocks which will do very well in the next cycle.
Okay. While this is not in the nature of recommendation, but because they are already a part of Valentis portfolios, maybe you can name those 4 or 5 stocks.
So, generally we don't like to name stocks because, see, there's always a risk reward in all these stocks. So, I always tell people like a stock is how much is a risk appetite. But we already mentioned all the sectors which we are bullish on. So, obviously, a lot of our stock picks flow from those sectors only.
Okay. Okay, fair point. Again, so we'll have to hazard a guess between banking, cement, pharma, and of course chemicals. In these 4 spaces, have you focused on large caps, or maybe uh,
So, yeah,
if
so,
you can just give a broad
so very
sense of
broadly,
direction?
we have two, portfolios which we run. So one is a multi-cap, where there's some large cap elements, some mid cap, and some small cap. And then there's a rising star, which is our small cap fund. So, I would say a lot of our money is more small cap rather
Hmm.
than large cap, just because of the nature of the money we got within these two funds.
Okay.
But our emphasis on the
Hmm.
portfolio picks would be similar both in the large cap and the small cap, because what you like is what you want to really buy. Uh,
Hmm.
and so, you'll find these sectors represented both amongst the large cap and the small cap for us.
Okay, so you see, basically, it's a question how earnings trajectory is likely to move. These mid caps and large caps are just marketing, or maybe just names that we've given to keep ourselves cerebrally occupied. End of the day, it's how the balance sheet pans out.
Yeah.
Mr. Jaipuria, a space that you are not looking at.
So, see,
IT, you mentioned you don't like it.
we never say no to anything. But I would say IT is something where currently we have not got a large
Ah,
weight. Another space we don't have a large weight is to the whole consumer staple area. And this is staples. So we may have in consumer other stuff in
okay.
consumer, but not the staples. And the third area where we are light today is probably the metal
Mm.
space, the global metal space. So for us, it is the global growth is a question mark.
Okay.
So we don't want to get too much involved with something which is very global.
So it's domestic focus via cement and to some extent chemicals, and of course banks. Banks are totally domestic focused. There is absolutely no tariff restriction on them. Uh, Mr. Jaipuria, when you look at the broader macro of our country, rupee is now appreciating. It's amongst the best performing Asian currencies. Crude oil at a 4-year low. Inflation is also now at a 5-year low. Forex is pretty fine. How do you look at the macro balance sheet? Are there any red markers, potential hurdles that you might encounter in the next 12 to 15 months?
So, I would say the macro in India is like in great shape. In fact, that's the whole thing which is driving like market remaining probably at valuation which are higher than normal. Because typically I look at the twin deficit. The twin deficit is under control and government has done a very good job with this coming down. So all the oil and all goes into your twin deficit. Second is the banks are in great shape, which is helping them. So that is enabling us to, put liquidity into the
Hmm.
system, enabling us to cut interest rates at a time where, there's a lot of global turmoil. So macro wise, it's
Hmm.
all looking good. We're going through what I would say a cyclical slowdown because the government stepped up after the COVID, and the government did a lot of capex, which helps the economy. But now the government capex is starting to slow down in terms of the growth rates. The private sector capex is not picked up at that stage. So there's a cyclical slowdown. Hopefully, the cyclical slowdown is at its low, and we'll see growth improving next year. But essentially, I would say growth is where we have to focus on a lot. And the second is just navigating a lot of these global turmoils which will come through over the years. Because you have a China slowdown which is there, you have US which is, up and down, but there's a slowdown, global interest rates are going up. So to that extent,
Yes.
those are some of the things we'll have to navigate for this year.
Mr. Jaipuria, taking the argument, the valuation argument forward in banks, are you just talking about the private sector space, or is this valuation comfort also available in PSU banks?
Yeah, so valuation comfort is across the board. In fact, when we think about it, we think more as retail and corporate banks rather than as public and private banks. When we break up the banks, because there was a time where if you go back into let's say 2020, you'll find a lot of the private sector corporate lenders were trading at valuations which are very very low relative to the private sector retail lenders. So the market also looks at it that way. So the valuations are there in many of the banks, which where they are quite attractive and quite cheap. What one has to think of course, is one is whether the deposit growth will keep pace and the credit growth will keep pace, or we have to just reconcile the asset to lower growth. Second is NPL scenario looking very good today. Hopefully, we are not at a cyclical low of the NPL, and from here to year later, we're looking at NPL pickup. At the moment, it doesn't seem to be. There are some pockets where there have been stress, MFIs, unsecured loans, but otherwise, in general, the NPL is looking quite good.
Okay. And does the same argument extend to non banking financial companies? Because the lending universe remains common, and of course, so does the regulator.
Yeah, so there have been quite a few regulatory changes in many pockets of this whole, NBFC when you think about it, whether it's the MFI, whether it's the gold loan and all. But in general, probably, for example, if you look at the housing loan market, some of the NBFCs are probably going to do much better than what the banks do also. And now the banks are starting to compete in a lot of the spaces where the NBFCs are. So for me, over the next 2, 3 years, we'll probably see NBFCs will find that suddenly banks are competing with them. But otherwise, they are nimble. They have, much faster approval systems and much better, maybe recovery system because they are smaller. And so I think, they will probably do better in a rising economy environment than probably what the banks can do. But then they'll be very volatile also because they are single product, one or two products. So when that product does badly, then you go down with it.
Okay. In your own two PMS schemes, do you have a presence of housing NBFCs, or maybe other NBFCs which are in the business of financing precious loans versus precious metals?
Yeah, so see, we have a mix of quite a few, and many times, you can play through the banks, you can play through the NBFC directly. So I would say we have a mix of banks which are get to, or
Hmm.
immune to that or exposed to that largely or through NBFC. So overall, we would play a lot of these segments in the BFSI because just remember, BFSI is a large part of your index weight. It's ultimately like probably a third of the each of the indices and BFSI. So you do have quite a few stocks in the BFSI space in your portfolio.
Uh, one uh, one space that we have failed to discuss thus far is both the two-wheeler and the four-wheeler space. Commercial vehicle maker Tata Motors benefiting from the UK India FTA, plus the fact that it's halved over the last maybe 1 year or so. Uh, any thoughts that you have on autos, primarily cars? They seem to be having a tough time against Chinese competition.
So, for the cars in general, I think, a lot of these FTAs which we sign is not going to be positive for them because ultimately you're opening up the India car market to a lot of global competitors at very very low import duties. It could be like zero, could be 10, could be 15, and I think we probably at least the media reports if you promised US also more or less zero import duty on the car companies. So to that extent, for the OEMs, we may be looking at tougher times as we go ahead because of the lot of import competition coming. I think the higher end people will be hurt more than the lower end cars, because probably you'll get the top end cars coming more easily through the import route. So for us, it's like probably the auto ancillaries are a better way to play this whole segment, because with the auto ancillary they'll cater to a whole lot of OEMs, and they have many parts which they can keep adding. Many of them are actually also diversifying because they have good engineering expertise. They're diversifying into some other products. Maybe they're entering defense also. So we find a lot of the auto ancillaries are better ways to play the auto segment than the auto OEMs themselves.
And my final question is on the energy space, Mr. Jaipuria. How are you now watching the price correction in the renewable space? Even frontline power producers are still way off their all-time highs. Is this a happy hunting ground for Valentis?
Yeah, so see, I guess there are many things in energy. So what is clear is India wants to increase renewable in its share of the whole power supply. So renewable is where you want to focus on. There are many ways to play renewable. You don't necessarily have to buy the renewable energy companies. You can buy the suppliers to the renewable companies. So for us, it has been playing the suppliers probably offers us a bigger delta and bigger alpha in terms of, rather than playing the producers themselves.
Okay. Okay. With that, Mr. Jaipuria, we'll call it a day here.
Yeah,
Thank you so
good to
much
talk
for
to you.
this
Thanks a lot.
wonderful discourse on where valuations are working.
Yeah, thanks.
It's a pleasure to host you, sir, as always. This, ladies and gentlemen, was Mr. Jyotivardhan Jaipuria, the CEO and MD founder of Valentis Advisors. Mr. Jaipuria has a fondness of picking stocks that flower over the next 2 to 5 years. He's a medium-term multi-bagger picker. And for the moment, his energies are focused on banking, cement, pharma, and chemicals. These are areas which are less or little impacted with the ongoing tariff war and are more domestic focused. For the moment, he seems to be avoiding IT because of the impact of artificial intelligence and the fact that valuations for the moment, given the paucity of guidance, look still to be stretched. Overall, he feels 2025 will be an year of consolidation. I hope you enjoyed the conversation as much as I did. Thank you for watching. Stay tuned to Business Today Television.
If you like the video, do like, comment, share and subscribe. If you like the video, do like, comment, share and subscribe.